अखंडमंडलाकारं व्याप्तं येन चराचरं तत्पदं दर्शितं येन तस्मै श्री गुरुवे नमः. Dear learners, welcome to the course on Essentials of Financial Management. We are into the process of discussing the dividend policy, which is the third most important functions of finance. The first two are the financing decision and second one being the investment decision. If it is taken wisely, then it would be resulting in some profit for the company, and now the management has to decide whether to distribute this profit or to retain in the company for the future investment or to retain in the company for the future investments. So, in this process we have discussed the conceptual framework of dividend policy, where we have discussed the pattern of paying dividend and also the form of paying the dividend to the shareholder. Thereafter, we have to see that whether the dividend policy affects the value of the firm or not, and in this case we have to encounter two type of opinions, one being the relevancy theory of dividend policy and other one is the irrelevancy theory of dividend policy. What do we really mean by relevancy or irrelevancy theory? We will discuss later on. So, first of all, let's start with the relevancy theory of dividend, where the point of discussion will revolve around the dividend policy and valuation of firm, Walter's relevance theory of dividend, what are the proposition of Walter's theory and what are the assumptions on the basis of which the dividend policy by the Walter have been propagated. Then we would also see what is the formula for bringing out the conclusion that the dividend policy has an impact on the valuation of firm. Then this would be followed by a practical example, and finally the merit and demerit of this model would be evaluated. So, let us start with the relevancy theory of dividend policy. What is the dividend policy? Dividend policy is nothing but a decision of the management where it is decided whether to distribute the earning of the company in the form of dividend to the shareholder or to retain the profit for meeting out any future investment opportunities. Here, the proponent of relevancy theory includes the Gordon, the Linter and the Walter, among others, who have propagated the relevance doctrine of dividend policy. What is the core belief of relevance theory? The principle on which relevance theory is based is that there exists a direct relationship between the firm's dividend policy and also the market value of the share. So, that means if the company pays dividend or company do not pay dividend, it would have a bearing on the market price or market value of the share. Here, it is interesting to note that the investor preference is not indifferent towards payment of dividend and retention of money. That means, they would treat the company differently, how the earnings of the companies are divided between dividends and the retained earning. Now, there are certain arguments in favor of the theory which says that there is a relevance of dividend payment for the market price of the share. So, the first argument is resolution of uncertainty. Now, the first argument which is set forth in support of relevancy of dividend policy is that the investors, they are always careful about the future, particularly about the uncertainty, and hence they would be interested in short run income which is more certain and assured than in the long run earning which are unpredictable. Now, since dividend reduces uncertainty about the level of earning for the investors, a stockholder would give greater preference to expectations concerning present dividend than belief as to what would be the trend in price and dividends over the long run. And third thing, which is related to the resolution of uncertainty, is to believe that the present value of income received in short run is always higher than the present value received in somewhere down the line. So, in view of this, stockholder can never remain neutral or can never remain indifferent between the dividend and the capital gain. Now, the second argument in favor of relevance theory is dividend as information content. Now, in arguing for the significance of dividend policy, it is always believed that the dividend decision affects share values because dividends and the manner in which they are paid, they are considered significant piece of information about the future earning capacity of the firm. We have also heard about the signaling theory of market valuation, where it is always believed that the information affects the market value of the firm, whether it is related to the dividend announcement or announcement of mergers or the acquisition. Similarly, a study has been conducted by Richardson and Patty, who have also given as the main finding of their study that the market reacts to announcement of dividend changes. Share prices will jump when there is a significant rise in dividend, and the converse will follow when dividend rate declines. We have also seen that there are three theories of market efficiency, which says a market can be weak, market can be semi-strongly efficient, and sometimes market can be strongly efficient. So, it is a semi-strong efficiency of the market which believes in the fact that yes, dividend announcement would of course change the perception of the investors and thereby the market price of the share, and as a result dividend announcement would carry more information than earning announcement. Third argument in favor of the relevancy theory is desire for current income. Any investor would prefer regular dividend payment to future capital gain. Why? Because the current income would help the investor to meet their current requirement. While Miller and Modigliani, they have argued that stockholder can liquidate a portion of his stock holding at time when they need money to cover their requirement. Let us see whether it is really true in the real life scenario or not. Now, the stockholder can procure funds by liquidating these shares and make use of their liquid money in whatever manner they like, but under uncertainty share price fluctuate and certain stockholder may be averse to disposing of share for income at fluctuating price. Now, along with this, it is not always easier to sell a small portion of stock periodically for income, and in addition to this there may be some brokerage and other cost that has to be incurred by the investors while selling the security, and that would consume a portion of income. So, finally, it is a risk, inconvenience and the cost which is involved in liquidation of shares, and it would make shareholders to have a definite preference for the dividend income from the company. Now, the fourth argument is sale of additional stock at lower price. Now, the irrelevance doctrine is based on the argument that the firm can distribute its earning and in turn it will be able to sell additional stock at current price. Now, however, in order to attract new investors or existing ones to buy new stock, sometime the firm may have to sell the share at discount or at a lower price. Now, the lender argues that the equilibrium price of a share of stock will tend to decline in correspondence to the sale of additional stock to replace dividend. What will happen? As a result, this mix of equity in the capital structure would result in a fall in the total value of the firm's equity, which implies that there is a definite preference for retention as against the payment of dividend to the shareholder. Now, fifth point that favors the relevancy theory is the tax saving. What is tax? It is levied on the income received by the shareholder in the form of dividend. Now, investor will also not remain indifferent between dividend and retention because of the difference in the treatment of these two income received from the company. Now, investors who are in a stiffer tax bracket would always like to firm to retain major portion of earning because this would help in reducing their tax liability. And this is also true that the capital gain resulting from growth of the firm will add to the tax liability of the shareholder, and as a result there will be no tax saving. But this is not true, because we should remember that capital gain tax which is levied on the long term gain, they are taxed at a rate lower than the tax on the ordinary income received in the form of dividend. So, that means there are difference in the tax liability for the investors. Further, capital gain tax would also be liable when the stocks are sold, while dividend income is taxed immediately when it is paid. So, for all these reasons, there is a propensity among some stockholder who would prefer retention of earning to current dividend. Now, there will be some flotation cost when the company is going to raise fund through the new capital in the form of shares. So, that means dividend paying firm have to incur some additional cost in the form of flotation cost, which will again increase the burden on the investors. Now, finally, the erratic behavior of investor would also be a responsible factor while deciding whether the dividend should be paid or profit is to be retained. What is erratic behavior? That means we have to believe and we have to accept the fact that investors are not always rational. Sometimes they may buy a security which is overvalued, and sometime they would start purchasing sometime even an undervalued stock, even though they expect that the share price may fall further. So, that means we cannot predict the behavior of the investors in the real conditions. So, in order to prove all these points and the fact that dividend is relevant for ascertaining the market value of the company, Walters has come up with a model which says that dividend policy and investment policies are inseparable business decisions. That means, dividend policy would establish a relationship, it means that the relationship between the firm's internal rate of return, that is presented by R, and the cost of capital is very important and crucial for determining the dividend policy. And it is assumed and it is ascertained that if R is greater than K, that means the rate of return is better than the cost of capital, the firm should retain the earning and it should distribute its earning to the shareholder in the form of dividend if the R is lower than the cost of capital. Secondly, Walter has also related dividend policy with the investment opportunity of the different kind of firm. Like if it is a growth firm where the R is greater than K, dividend policy and the optimum payout ratio would be different, as against a declining firm whose rate of return is lower than the cost of capital. And this has been proven by the Walter with the help of certain assumptions. What are the assumptions? Here, number one, that the retained earning constitute the exclusive source of finance. That means, company do not rely on debt or equity for financing the projects. Second assumption is that the firm's internal rate of return, that is R, is and the cost of capital will remain constant, they will not change. Third, the firm distributes its entire earning or retains them for reinvestment immediately, and there is no change in the value of earning per share, that is E, and also the dividend per share, that is D. And so, that the value of E and D may be changed only in the model to determine the various result in different scenario. And finally, the firm also has a perpetual life. Let us find out whether the assumptions have supported and in what way it has supported Walter to prove that there exists a relationship between the dividend policy and the valuation of the firm. The formula is like market price of the share is equal to the D upon K, that is the discounted value of dividend plus R multiplied by the difference between the earning and the dividend paid divided by cost of capital. So, here P represents the market price per share, D stands for dividend per share, E refers to the earning per share, R is the internal rate of return, K denotes the cost of capital. Now, we will understand this theory with the help of one practical example. Let us see, in this particular case, capitalization rate, that is the cost of capital, is 10%, earning per share rupees 10, dividend per share would be discussed in two different scenarios. Number one, when the dividend payout ratio is 0, and second, when it is 50%. That means, out of an earning of rupees 10, company would be paying 5 in the form of dividend and would be retaining 5%, rupees 5, or the 50% of the earning would be retained. Now, the implication of this policy would be seen in three different scenarios, denoting the three different firms. One, the growth firm, second, normal firm, and a declining firm. Now, the growth firm is one where the rate of return is 15%, normal firm is one where the rate of return is just equal to the capitalization rate, that means the K is 10%, whereas the rate of return is also 10%, but the declining firm is represented by a rate of return which is lesser than the cost of capital. So, cost of capital being 10%, now the rate of return is only 8%. We would tell you how to calculate the value of firm, giving you a detailed calculation where we would substitute the formula with the value given in the question. Now, here P is equal to 0, that is the first scenario when the dividend is 0. So, 0, that is the dividend, plus the rate of return, that is 15%, and E, that is the total earning of the company, minus D, that is the dividend, which is 0 in this case, the whole discounted by the cost of capital, that is the 10%. Now, if we have to solve this equation, we will calculate first the multiplier. Here 15% upon 10% gives us 1.5. If we apply the multiplier to the earning minus dividend, what we get? We get 1.5 multiplied with earning minus dividend, so as to have a result, that is 15. Now, if we add dividend to it, that is 0 in this case, plus 15, that is the result of 1.5 into 10, we get 15, and if we discount it or divide by K, we get the value of the firm as rupees 150. So, you can say that the value of the firm in this particular case of a growth firm comes out to be 150, and this has been possible only because of the fact that the rate of return is 15%, which is more than the cost of capital. So, the additional 5% that is obtained over and above the cost of capital would get reflected into the market price of the company or the share. So, here if we would like to show here how the calculation has taken place for the growth firm in three different dividend payout scenario, when it is 0, when it is 5, and when it is 10. So, in the first case, no dividend is paid out, secondly it is paid just equal to the cost of 50%, and in the third case all of the earnings are distributed to the shareholder in the form of dividend. So, we can see the result. So, as we move towards the payment of dividend, it is very disastrous for a growth company, and we can see that the value has come down from 150 to rupees 100. Now, we can see the calculation of price for a growth firm and also the ultimate conclusion for a growth firm. And here in the case of growth firm, there exists an inverse relationship. So, we have to remember, higher the rate of return, the lower the higher the rate of return as compared to cost of capital, higher the value of shares when the dividend payout ratio is 0, and as the payout ratio increases, share value declines, and share value is the highest when the dividend payout ratio is 0. So, what we conclude? We conclude that if it is a growth firm, it is utilizing the firm, it is utilizing the return in a better manner, then it is always beneficial to retain the profit instead of paying this to the shareholder. So, thus optimum dividend payout ratio comes out to be 0 for a growth firm. If we repeat the same exercise for a normal firm, what do we mean by normal firm? Where the R is equal to K, that means the rate of return, which in this case is 10%, is equal to the cost of capital, which is also 10%, and we can see that the share price is rupees 100. In case payout ratio is 0, it is rupees 100 when the payout ratio is 50%, and when the payout ratio increases to 100%, that means all its earnings have been distributed, it is again rupees 100. So, the concluding remark could be that in the case of a normal firm, share value remains constant regardless of the dividend payout ratio. So, here a normal firm can have the optimum dividend policy in a manner which remains constant. That means, neither payment of dividend nor retention of profit would increase or decrease the value of the firm. Similarly, for a declining firm, what do you mean by declining firm? Where the rate of return is 8% and the cost of capital is 10%. So, if we put the figures into a formula, we can see that the value of the firm is rupees 80 when there is 0 dividend paid to the shareholder. It is rupees 90 in a case when the dividend is merely 50%, but when dividend is 10 or rupees 10 over 100%, it is maximum, it reaches to rupees 100. Now, the principle behind this increase in the valuation of firm lies in the fact that a declining firm is getting a return on the investment to the extent of 8%, where it has promised to pay 10% to its supplier of funds. So, when the company has not been able to utilize the fund in a better manner, which can at least recover the cost of capital, now the firm's value will keep on declining, the firm's value will keep on increasing when the company retains lesser profit, lesser earning, and pays maximum dividend to the shareholder. So, the optimum dividend payout ratio is 10% in the case of a declining firm. Let us have a summary. Here we can see for a growth firm, rupees 150 has become rupees 100 when there was a increase in the share when there was an increase in the payment of dividend, and vice versa we can see in the case of a declining firm, whereas a normal firm remains indifferent because the cost of capital is equal to the rate of return. Now, can we evaluate the Walters model? Here we can say that the model has very well established the relationship between the dividend policy and the value of the firm, and that also reiterate that there is a link between the company's dividend policy and its overall value. The factor that makes this model very, very attractive for all the readers is that it is very simple and practical. That means, it is easy to understand, it could be applied for evaluating dividend policy. Secondly, it has also established the linkage between the investment and dividend decisions, and it has recognized the fact that the finance manager has to take lot of pain while deciding the dividend payout ratio, and this model can also help the management in formulating their dividend policy as whether to retain the earning or to distribute to the shareholders. Now, there are certain demerits of the Walters model, though it has proved that there exists a relationship between the two variables, that is dividend policy and the value of the firm, but this model is criticized on certain points because it is not very practical for the real world, and the problem lies in the fact that the model has taken the help of certain assumptions. Number one is the assumptions regarding the constant R and K. This model assumes that the internal rate of return and the cost of capital remain constant, which is unlikely as R usually changes when there is a change in the size of the investment and also the nature of investment, and K can also change when there is a change in the risk profile of the financing of the company and also the combination of the instrument that have been used by the company. It is very impractical to assume that there is no external factors like the taxes and all. So, again this proves to be a point where the model lacks practicality, and the model has also suggested that there can be 100% payout or 100% retention as the optimum dividend policy, whereas it is not always practical for the firm to either retain 100% profit or to distribute 100% profit in the form of dividend. The company always try to have a mix of retention as well as payment of dividend. So, these are the demerits of Walters model. So, with this we come to an end of this particular discussion on the relevancy theory propounded by Walters, which is based on the premise that yes, there exists a relationship between the policy designed by the management for the payment of dividend and the market value of the share. Thank you very much.